Well, the recent rout we saw in markets worldwide with the pullback because of China and, of course, the uncertainties around Greece would have made a lot of people quite nervous about index investing, and that's maybe where an active manager comes to the fore. But where 80, maybe 90% of active managers still can't outperform the index on a regular basis, let's have a discussion on being a little bit smarter when it comes to passive investing versus perhaps smartly choosing an active fund manager. Plessis is with Citadel, and Chris Freund is with Investec Asset Management. Two guests this evening on the Moneymakers with Bruce Whitfield. Welcome to the show this evening. You guys underperform a lot of the time, broadly, as a class, don't you, Chris Freund? It's very hard. Very hard. Active managers, underperform the index a lot of the time.
Look, I know that's the sort of mantra around the world, that active managers underperform.
Well, it's the data, the mantra.
Well, I disagree, in fact, because in my career, in South Africa, I can talk for the South African market. Institutional South Africa tends to outperform the market indices somewhere between 1% and 2% over time. Not every year, clearly, but if you go back and you plot the last 10 to 20 years, unless we beat, for example, the SWIX by 1% to 2% per annum, we are going to underperform our peers.
One looks at it, though, in the last 7 years in particular, post-2008, markets took a bit of a dip, and it's been very difficult to outperform the index. However, you simply bought Satrix 40 at a point in 2009, I think probably June 2009, when the market bottomed out. You've made a lot of money. You've tripled your money, probably. Very few asset managers would have done that for you.
Look, there are different styles and there are different times in the economic cycle when active managers do well versus passive managers. So I'm not saying that we can never underperform as active managers. Absolutely we can, and we have, and we will do again in the future. However, there are definite times when active managers will outperform a passive strategy. And I think to an extent it depends on the structure of the market. So, for example, in Japan, there are hundreds and hundreds of companies listed, and in the US, it's quite tricky to outperform those markets. But for example, in South Africa, and we would put Europe into our market, similar to our market, it's easier. So what makes it easier to outperform here in SA and Europe and not in the US and Japan? Well, a couple of things. First of all, if you have the market dominated by a couple of very large companies.
But if you'd bought just the top 10 companies by market cap on the JSE in the last 5 years, you would have outperformed, because they've made the market, surely. They make up 85% of the value of shares traded in a lot of cases.
That's completely oversupply. Like right now, okay, that argument would take Naspers is something like 12% of SWIX, somewhere around there. So are you advocating that we should put, say, 12 or more % of our clients' money in Naspers? It's a sort of or you've almost got an on-off switch in the portfolio. If you get Naspers right, you win. If you get it wrong, you
But the index has got that proportionately, and that's why the index has, Hannes, outperformed the vast majority of active fund managers over the last 5 or 6 years or so. But it's not always good enough just to go into a Satrix 40. Can one be smarter than just buying an index? Because the index has shifted, of course. I don't think there's a single gold share left in the index, but there was a time when they were, and they were underperforming. The index versus the active manager.
Sure. Chris, it's a very interesting question. What we mean by a passive investment is something that needs to be clarified. Typically, the definition we use is that a passive investment is something that conforms to market capitalization weight in any given market that are under consideration. And it's sure. So that's important, because passive has got nothing to do with the level of activity or the style of management or the type of things that it does, but really in this pure definition, it's conformity to the market capitalization weighting. Now, we've known through academic research all the way since the early 90s that the pure market cap index is not necessarily the best payoff that the client can enjoy on a risk and return perspective. So that begs the question, can there be something better that can be constructed systematically and at low cost? Those are the two important features that are normally the benefits of passive investing. Systematic description of the strategy to the level where one can produce a rule book, and it can be done by anyone independently with complete transparency, and being able to be done at low cost. Those are the two important benefits. But the question is, can one do this slightly better with a payoff to the end-line client that is better than that of a market capitalization index. And the answer that has emerged quite strongly in recent times is yes, it can indeed be done.
You call it smart beta, right?
Right. That's a terrible name for a very, very interesting trend.
Yeah.
It's a terrible name in the sense that these things, these betas that are said to be smart, I mean, they are simply there. What we normally refer to these things in more precise language is that they're risk premia or risk factors. These are specific systematic exposures to risk in the market that earn some sort of a reward. Right now, those exposures are not smart; they're just there. Right? They
exist. Yes.
Strategies can be smart. A human chess player can be smart, but exposure to a specific risk factor is not necessarily smart. So
who chooses which of those exposures to take?
Oh, indeed, Chris, that's an interesting question. Of course, there needs to be some sort of a professional investor that chooses this, and then one can say that's actually an active
But exactly,
investment.
that's the point. So
right?
it's no longer passive. So
Yes.
at what point is passive and passive then semi-active? A bit like me going to the gym, not that active at all, but still participating.
Exactly. So hence my preference for the definition, for the clean, clinical, academic definition of passive is matching market capitalization weighting. So anything that deviates then from market capitalization weighting should be called active, right? So, and then the difference is simply in the amount of discretion versus pre-specification of the strategy.
Okay. Lots of big words, Hannes, lots of big words. Explain it to me then in terms of how you keep a level of activity, because you talk to somebody like Magnus Haystack from Benthurst Wealth Management, who, when markets are elevated to the extent that they are at the moment, he's a big proponent of active management because you can get in and out of positions. And whenever there's a bit of volatility, it becomes a lot harder to be married to an index.
And you don't get forced by definition to buy the shares that have done the best, that potentially are the most expensive, which you do in a pure passive strategy.
So can you be smarter then than a pure passive strategy without incurring the costs that an active manager might lumber you with?
Sure. And there indeed the answer is again yes, in that if one takes the passive market capitalization index and factor it into different risk factors or risk premia, so you have different portfolios that in the aggregate constitute the market, you find that each one of those have different risk and return characteristics, and they have a payoff profile that pays off during different market environments.
Could I explain it like this?
No, please, because for an average schmuck.
No, let me explain it like this. So you can either buy the whole all-share index passively, which we've all, I think, three of us decided is not such a clever idea.
It can be. It's been clever for the last 7 years, but it may not be clever now.
Well, it hasn't been clever for the last year or two, I don't think. Okay. But anyway, there's debate about, there's uncertainty about that strategy, if I could say that. So then you can also choose, as Hannes is saying, well, perhaps you just want a portion of the index. You want the resources portion of the index, or you just want to buy exposure to the South African banks as a group. Okay. So you can buy an index that will give you exposure just
you buy
to the
Resi
South African
or the Fendi
banks.
or whatever the
case
may
be. You can, let's just say you can buy the Resi, so you just get resources. Now, so whatever the resources as a grouping do, you'll get that return. Okay, that's called the beta return. That's called that's that. But you are invited potentially to choose specific resource shares, and that's the extra return over and above whatever that grouping gives you. That's called alpha.
So this prompts me to ask you the question about resources shares, because in your value fund at Investec Asset Management, you guys have been quite fond of some of the resources shares for quite a while. At some point it's going to come right, I have no doubt. But boy, it's hard to be a value manager, isn't it, Mr. Freund?
Correct. and thankfully I'm not one.
No, but it is. I mean, but that's
I'm very far from a value manager, but absolutely there's a time in the cycle when value managers will do very well. There's no doubt about it. It happens to have not been for a while now. My own view is that value managers in South Africa, many good managers, have confused value investing with resource investing. And if you'd given them all a sort of financial and industrial mandate, they would have done far better than they have done in the last 5 years, because they have perceived the low PEs in resources to be good value. The problem about in the resources sector, your E can disappear when the commodity price, or whatever it is you dig out the ground, falls. there's no sustainability to your E.
We just look at the gold price below 1,100. We look at platinum price below 1,000. We look at a falling iron ore price and the impact that's had on Kumba, for example. Those are devastating. So we're in an uncertain environment. The US is recovering. The UK looks like it's got something going for it. There might even be something of a recovery in Northern Europe. But we've got uncertainty in China. They claim a 7% growth rate. We certainly know that Greece is sort of spending borrowed money to pay off its debts, and that thing's going to come back in the next 3 months or so to create a new level of uncertainty. We've got a currency that is more wobbly than a bowl of jelly. What investment strategy should we be looking at on a 5-year view?
Hannes, do you have any particular smart beta ideas that you'd like to answer that question?
Well, we can perhaps
Thank you for facilitating that so beautifully. I think it's called passing the buck.
No, I just don't want to hog the limelight, so I just want to give. I've got some firm views on this.
There we go. We'll get them now.
Okay, but perhaps in context to extend from Chris's earlier observation that you can take this market and you can sort it into resources stocks or financial stocks or so. You can also sort it into other sorts of portfolios which are interesting. You can sort it into a value portfolio for interest sake. You can sort it into a momentum portfolio. A value portfolio earns the payoff to securities that are valued cheaper relative to their intrinsic value. Momentum portfolio earns the payoff to securities who have recently risen in price. There's some sort of a continuation effect. There are many other such, we call them factor portfolios, that one can put together.
But which ones right now would you actually plumb for?
Now, given the scenario that Bruce has suggested, it's looking a little bit shaky and all this, there's also something called the low volatility premium or factor portfolio, and that is perhaps a very interesting contention for the moment, because this is a portfolio that is fully invested in the equity market, but normally at 2/3 of the risk level of the equity market. Could be an interesting one at market turning points.
You're a fan of momentum, though, aren't you?
Lovely to hear you all so cautious. It can mean the only the market's going to go up, really, because it's only when everyone's absolutely euphoric do I get nervous, and we're far from that point. Okay, so the Greece and the China that you mentioned earlier on, those are what we call tail risks. If those had sort of come to fruition, things would have gone badly wrong. Okay? I think those are receding. So we're back to the normal part of the cycle where we worry about rising interest rates, which is bad, and rising earnings, which is good, and that tension between them. So when we run other people's multi-asset money now, we actually still have a bias towards equities. We think they're slightly expensive, but at this stage of the cycle, they're going to become more expensive. And within equities, we're not going for resources.
But you're a fan of momentum. You like to look at companies that are doing well, and on that basis, you've got quite a complex way of thinking about it. But companies that do well continue to do well.
Yes. But remember, we are not price momentum managers.
No.
Just because the share price goes up.
No, but you look at earnings. You look at earnings momentum.
And we look at the change in earnings. It's not even. We don't even go for companies with high forecast earnings growth because we think that's a losing strategy. We're ambivalent between a company that's going to grow its earnings forecast by +20 or -20. We'd equally invest in those. All we're looking for is that -20 goes to -10% expectation. So it's the change. It's the delta, or the +20 goes to +30. Now that's what's called an upward earnings revision. And when you tend to get companies where the earnings have been revised upwards, those are the companies that outperform because people underestimate how far those upward earnings revisions are going to go on for.
Does this market go another 10% by December?
Absolutely.
Honest?
Possibly.
Come on. Oh, such chickens. Honest to see at Citadel. Thank you very much. He's at Citadel Asset Management. And Chris Freund with Investec Asset Management, considerably more optimistic than the rest of us. But it's always good to have an optimist in the room. That's it from the Moneymakers, from these two Moneymakers and myself. Good night.